Well, that's the picture at 11 o'clock. As always, we'll invite Ajay Srivastava from Dimensions Corporate Finance Services to join us on the show. Ajay, make sense of all the news flow for us, and what should investors do?
I think, there is more news flow than anyone can reasonably expect to handle. So in which case, I think you just go back and relax, because there's nothing you can do. Events are moving faster than you can evaluate. Things are volatile at this point of time. And you know what, Rima, one thing stands out. And I think that's the most important thing which amazes me. No other global leader or a company or a country has ever come out with the radical policies to balance out what's happening in America. America has done what it has to do to protect its interest. But whether it's China, India, you look at UK, France, none of them have done anything at all. What stops us from having a large GST cut? You do change the regulations, free up the economy. And on top of that, we have RBI again saying, I've got a new gold loan. Anything which works well, the regulatory scenario in all the developing countries means go tap it, change it, and I'm going to take you out. So if you look at India's history, we had a capital gains tax, we had a huge pressure on F&O, trading volume, margins have been put, change of this, settlement date changes. You name the interventions, but the big ticket is missing. You need to match America. America has done grand stuff, actually. We may not like it, but from their perspective, they've done what they could. The biggest economic moves have been made. It's up to the countries to respond now, and each of the country can only be blamed itself if it doesn't respond to what's happening in America. So investors, I think you brace and wait and see whether your government, and it goes for any country, will respond to what's happening in America in a more constructive way. It's not happened so far. Will it happen? I do not know. But today was a gold loan regulation for RBI was disappointing. It was not required. But again, we need to push the levers of anything which goes well. That's the beauty of bureaucrats. Find me a good thing. I'll tell you how to unfix it.
So what would you do then with gold loan companies like Muthoot Finance, Manappuram, Chola, IIFL Finance? All of them, as you can see on your screen, are reacting, and they're worried about what might come out in terms of these comprehensive guidelines. You clearly don't like the idea of them being regulated. What are you most worried about, and what would the advice be on these stocks?
I think RBI is going to be pushing the gold loans towards the banks. The banks have been the biggest loser in the last 5 years on gold loan. They just couldn't get their act together. They're lazy bunch of banks we have in India. And what RBI is trying to do, and I guess we are all guessing, nobody knows what the regulation looks like, so we're all guessing it. My guess is that the regulatory nudge will be that let the banks become more competitive by bringing out pressure on the gold loan companies. I think net, this is what RBI has done in the last 10 years or 20 years. This is what they will do to get the bank a little more competitive edge in the market, but using the regulatory levers. There's nothing else needs to be done. The guideline was changed last year. We had a weighted measure on gold, the gold price saying you penalize the companies which flouted the law. It was doing well. If you go around the country, people had very easy access to gold loan. There's nothing you need to do. It was working quite well. So my only guess is the nudge is going to be move the business away from gold loan companies to the banks. That's my only guess. Nothing else was required in my view, and we'll wait and see what the guidelines unearth, something, which is totally, we didn't look at it or it was hidden under the carpet, but I doubt it. It's all about push the business to the banks.
Ajay, take your point completely on board. However, are you a little surprised in terms of the reaction, given the fact that the new norms are still to be notified? The RBI said there will be a comprehensive set of regulations that come into impact. One of the key points, like you mentioned, could be the fact that they could nudge more gold loans towards banking sector. What could be some of the other aspects that RBI is looking at? Are they worried about the lending practices itself from NBFCs?
See, Vivek, the market is fragile. You're putting into a mysterious regulatory point just as the market is most fragile at this point. Investors are literally at tenterhooks. People have just started to build back a little bit yesterday, and next morning you throw. So it's not about just the regulatory, it's also about timing. You got to be a little smart about, doing these things in a market where investors, companies, etc., are more confident of the future and they can absorb regulatory changes. Once you throw a bombshell in an already, it's like saying that let me pour some more kerosene on the fire and let's see the fun. No, its reaction is overdone. I think nobody knows the guidelines, so selling off is the thing, but just market is fragile too. It cannot take any change. That's all it's telling you. And I think we need to recognize that this market needs a cooler hand, a saner hand, a stable hand, not changes at this point of time in a regulatory scenario.
Ajay, own any IT in your portfolio? or in your client's portfolio?
Zero, absolute zero IT. And I think the reason was different, not because of the tariff, but the reason was the growth rates were looking very anemic in the US. And, Indian companies have not really done what it is. And number three is, thanks to our guidelines, we can invest directly into technology companies across the world. So Indian technology companies were not the most attractive bets at this point of time. So we have zero at this point of time. But having said that, there may be a time which will come when we will come back and buy it. But let's ride out this uncertainty which is killing us at this point of time. And maybe there will be, the GCCs, the capability centers might get a leg up thanks to the US tax cut which are coming into place or should come into place. So, in this volatile environment, you should rather stick as a concept. We have stuck to domestic industries, relatively unaffected by what's happening in the US, tariff barriers, export, import. So, the only safety is buy India, make India, consume India is, I think, the safer place to be at this point.
Understand that, Ajay. Ajay, if we could, once again look at the BFSI pack. Post-policy today, there were expectations that NBFCs actually stand to gain from the rate cut. But what we've actually seen is quite a bit of a sell-off even amongst the NBFCs, gold loan NBFCs aside. So at the current juncture, how do you view NBFCs and also your view on banks?
NBFCs have always been the poor cousins in the banking environment. And unluckily, as I told, same issue with RBI is that it just nudges everything towards the way of the bank. So NBFCs have by and large been uncompetitive in the scenario. Only maybe 2 or 3 have been able to thrive and survive, the larger ones, if you look at it. But apart from that, the whole industry has plagued with underperformance. And not that they have done great justice. Some NPAs come out, something come out. MFI, you see what's happened to the merger of MFI with banks. They have been a disaster. So, the point still remains that the regulatory overhang favors the banks at this point of time. NBFCs are volatile because regulatory changes can change dramatically. And number 3, of course, is that as the economy starts to slow down, and which is very visible at this point of time, NBFCs are left with lending to segments which they should not be lending to, and the risk is going up now in their business. So what was a good borrower last year may not be a good borrower this year. I think that's what is happening today, that the quality of borrowers is going down. And, in an environment where the wealth impact, Vivek, look at the wealth impact. Look at, if you were an investor, but sitting with a portfolio surplus last year, you were willing to spend money and you were willing to borrow money and, invest or consume. Today, when you sit 1 year down the line with your portfolio devastated, economic uncertainty, would you be a willing borrower to buy for consumer durable cars or houses and so on and so forth? I think propensity to consume is going to go down with all the volatility and wealth impact, and that will first hit the people who used to borrow from NBFCs and who used to pay a little higher rate than the banks. Therefore, they were a little less credit worthy. And I think that's what's going to play out now in the next 6 to 9 months till the things stabilize. The NBFC's borrowing population, I think, will shrink and the quality will deteriorate.
The negative wealth effect has got to start hurting at some point of time. But Ajay, what about staples? The only sector today which is strongly in the green is Nifty FMCG, 1.5% higher. It falls in the bucket of Consume India. RBI's inflation projections for the first 3 quarters of FY26 are below 4%. And plus, there was that budget boost. So in your domestic-oriented portfolio, does FMCG find its way?
Unluckily, there's very little we have in the FMCG for the simple reason that the competitive intensity has become huge in the local market. And that's where it is hurting everybody. It's not that demand will not go up, it will go up. But look at the number of new players coming to place. The quick commerce players are coming directly. The newer players are coming. The malls are coming. The Reliance retail kind of stuff are making their own product at this point of time. So, so the environment is getting so crowded on a 6 to 10% base of economy. Every day we find a new player coming and a new segment. Look at the products. We want chemical-free soaps, chemical-free detergents, where Hindustan Liver doesn't have the product. You want more organic stuff, and it's selling. You go to Amazon, you're selling. Companies like Two Brothers are selling crazily out there, but they will not buy an atta from a large company in India. So, the market is getting fragmented, is getting into different areas where people are not able to do it. That's why the edge with the FMCG had is gone today. This competition is killing everybody in the market today, and the new players are entering. So in the Consume India leg, I would still say hotels, hospitals, aviation. I think the 3 legs to this one, which continues to grow and be safer bets for you. FMCG is going to face serious competition from all around them. There can be a temporary 1-2% blip up, but if you're in equity, you need to be at 20% return expectation. If you want to make 8-10% or 12%, you might as well buy a gilt fund. It will give you 10-12%. So investors have a choice. You want 10-12%, just buy a gilt fund. It will give you that return. You want 12-14%, you go buy a power transmission REIT, will give you the return. But if you're in equity, you not to look at 20-24% return, and that's not going to come from FMCG.
Completely take that point, Ajay. Ajay, one sector that's been in the midst of very heavy news flow and largely negative has been the pharma pack. You spoke about domestic-facing hospitals as something that you'd like to own, but how do you look at the pharma pack, especially generics that supply significant volumes to the US market?
Again, Vivek, they're very good companies, okay? And we had large investment. Today, we have almost zero. But the point remains that uncertainty is killing the investor at this point of time, and you don't need to worry about being late to the party. You have enough time to go back in pharma. Nothing wrong in the companies, very strong companies, almost debt-free companies. Cash flow is humongous. Everything is good. But again, the point is the uncertainty of tariff. How will they react to it? What will happen? Almost 50 to 60% sales of most companies are to the US market at this point of time. How will they diversify away? We don't know the answers at this point. So I think it would be wise to just wait and watch. But let me tell, they are excellent companies. You cannot duplicate them. Even if America wants to shift it to America, it cannot happen. The production capacities cannot be set up overnight, certified. It takes a pharma plant literally 5 to 7 years to stabilize and get certified. So it's not something which you can switch, or it's not like assembling phones. You can start it next morning. So this is a different business. So owning this company is a very good idea. They're very good companies. But as I said, just wait a week, 10 days. Let's see where the play comes from the US side, and we will know the answers. But long term, it's an excellent thing to own these companies. They'll give the best return. Domestic market, which is 40% of these companies, is doing reasonably well. It's not grown so much because maybe we're getting healthier, except in people in Delhi where we are dying of pollution, but others are going healthier at our cost. But I think it's a good place to own yourself. Just wait 10 days and see where the tariff comes.
Got that. Thank you very much for that. Some buying is emerging in the, domestic two-wheeler names. So Hero Motor Corp, Bajaj Auto back in the green with a gain of about 1%. That intraday will come up for you on your screen. On the other side is commodity corner. Manisha Gupta joins in to tell us what's buzzing.